Good evening. I'm Jessica Leno, and I'm the interim director of the Stanford King Center on Global Development. The King Center is a joint venture between CEPR, where we are right now, and Stanford Seed, which is based at the business school. And we work to catalyze research, engage students, and inform policy on topics related to global poverty and economic development. And thank you very much for joining us at this first speaker series of this academic year. This series brings distinguished scholars and policymakers to give talks that we hope will foster discussion about the successes and challenges on global development. And we are very thrilled tonight to welcome Gita Gopinath. Gita is the John Svastra Professor of International Studies and Economics at Harvard, and her research focuses on international finance and macroeconomics. She's currently on public service leave to serve as the chief economist of the International Monetary Fund. I don't want to take time away from her talk to tell you about her numerous awards and accolades, but just to name a few, she's the co-editor of the current Handbook of International Economics, and she's an elected fellow of the American Academy of Arts and Sciences and the Econometric Society. She received the Pravasi Bharatiya Samman, which is the highest honor conferred on overseas Indians by the government of India, and Foreign Policy just named her one of the top global thinkers of 2019. I'm really looking forward to her talk on the future of the international monetary system. But before we welcome Gita to the stage, I'd just also like to introduce Pete Klenow, who will be moderating the discussion tonight. Pete is the Landau Professor of Economics at Stanford, the Gordon and Betty Moore Singer Fellow at CEPR, and the Dongwei Faculty Fellow at the King Center. He got his PhD from Stanford and his BA from Berkeley, so he didn't travel far. He's also a co-director of the program on economic fluctuations and growth at the National Bureau of Economic Research. He's a macroeconomist as well, and his recent research focuses on understanding how trade affects job reallocation and innovation. Please join me in welcoming our distinguished guests.
I have to thank Pete for inviting me to do this. So I'm going to talk about the future of the international monetary system, and it's pretty natural for me to talk about this at this point, given that I'm right now at the International Monetary Fund, and it's one of the institutions that pays very close attention to the functioning of the international monetary system. So let me give you a bit of a roadmap about what I plan to cover. So I want to talk some just about exactly what the international monetary system is right now. And I'm not going to talk about there are many aspects of it, but I'm going to focus on a kind of a subset of it. And this is getting a lot of attention recently because an important defining feature of the monetary system is about the use of certain currencies in international transactions, in cross-border capital flows and cross-border payments, right? And recently, with all of the renewal of interest in currencies, and especially with the issuance of private money and digital currencies and Libra, stable coins, all of that has made people think again about how is this going to affect the international monetary system as we know it. So it's getting a bit of a resurgence of interest in this question. So I'll describe what the current international monetary system is. And I'll describe it as basically being one of what we call US dollar dominance. I'll point out what the implications of that are, because there is a dominant dollar currency. And then, of course, the question that always comes up is this how it's going to be for the foreseeable future, the dollar dominance? Or do we think that there are actually real contenders? The euro, the renminbi, and now possibly privately issued digital coins. And so for that, you want to think a little bit about what is it that makes a currency a dominant, how do you end up with a currency becoming a dominant currency? So I want to talk a little bit about that, which is what's the making of a dominant currency. And then I'll talk about where I think where things stand for instance, for the role of the euro and the renminbi and the possible role they might have in sharing, if not dislodging, but sharing some more of the space in the international monetary system that the dollar has right now. And what role, if any, is there for digital currencies, including central bank digital currencies, which is something else that's being talked about a lot. And I will end with saying that at least for the foreseeable future, it seems like we will continue with the current scenario of the international monetary system. And then the question is, how should countries that are not the US, and especially emerging and developing economies, how should they deal with being a part of this kind of a monetary system? So I'm going to jump in. So here, let me just show you a snapshot of the current international monetary system. So each one of those, bars and graphs over there basically tells you the importance of the US dollar relative to other currencies in many different spaces. Okay, so the first one there is on foreign exchange reserves. So you have central banks, international central banks, accumulate some of their assets in terms of a foreign currency asset. Those are called foreign exchange reserves. And if you see what you see there is that the dollar makes up about over 60% of foreign exchange reserves. The euro is a distant second with 20%. And then there's pretty much everything else, right? And it falls off really quickly. So then if you look at the second set of bars, which is looking at international debt and the currency issuance of international debt by other countries in the world, again, the dollar dominates, which is that it tends to be that for most countries, when they are issuing debt internationally, they don't do that in their own currency, but they do that in dollar terms, in a foreign currency, and it's most often the dollar and sometimes the euro. And similarly, if you look at international loans, again, the country that's issuing it is not issuing it in its own currency, but it's happening in the form of dollars. Invoicing, that's about international trade, and what it basically says is that there's a whole lot of international trade where the US is on neither side of the trade transaction. That's being done, again, in dollar terms. Again, the euro comes in second, but again, a distant second. And then you have the global payment system and the SWIFT transactions, and again, there you see the dollar dominates. So this is the, if you want to think of the international monetary system in terms of what currency plays a dominant role pretty much everywhere, it is the US dollar. And especially since over the last 10 to 15 years, almost 20 years now, we've had an increasing role of emerging and developing economies in international trade and international capital flows. What that means is that the dollar's importance in the functioning of the international monetary system has become even more important, because these are the countries that tend to use the dollar in their international transactions. So there's a nice figure here on the right, which is from a paper by Carmen Reinhardt and Ken Rogoff, which basically says, let's look at the world and look at what is the anchor currency for the world, right? So you take a bunch of countries, and some of them have freely floating exchange rates, so they're not really anchoring to any currency in the world. But there are a whole bunch of countries that are actually anchoring to one currency, right? And so they have some amount of intervention in foreign exchange markets. They're trying to keep their currencies aligned with the dollar. And so that's the anchor currency. So the question is, which is in terms of the number of countries in the world for whom the anchor currency is the US dollar, you can see that that's the vast majority of them. And especially if you compare that to, say, during the years of the Bretton Woods years, it doesn't look any different, right? And during the years during the Bretton Woods era, you actually had a system where the dollar was pegged to gold and everybody else was pegged to the dollar. So that was the original system. The US dollar was the anchor currency. But now there's de facto, again, a scenario where the US dollar is the anchor currency, and most other currencies in the world don't really have that role to play. Okay, so now the question, of course, is that why do we care about why do we care about this fact at all? But why is it that there's one currency that's dominating? And the reason we care about it is, there are a bunch of reasons for it. I'm going to give you 3. So the first is the fact that there is a ton of research that basically now shows that monetary policy in the US, financial conditions in the US gets transmitted to other countries in the world very rapidly. And so you can see international capital flows, which is what the red and the green are in there, and you have the Fed interest rate, which is the solid black line, and you have financial conditions, which is the purple line. And you basically see that this is one thing that many emerging markets worry about, that when you had the period, for instance, when the Fed was raising interest rates in 2018, then there was this outflow of capital from a bunch of emerging markets, especially if you look at the non-China portion, that's the green bars, and you can see they're all in negative territory in 2018 when the Fed was raising interest rates. And now it's come back a bit to, the flows have returned now that they stopped that and they've actually started cutting interest rates. The right-hand graph is a similar kind of an analysis, trying to say that if I look at capital flows coming into emerging and developing economies, and how much of that is driven by global factors, and that's usually US-centric factors, as opposed to their own specific conditions at home, the global factor seems to be very important. So this is one feature. There seems to be a big global financial cycle, and Helen Ray made a big point about this a few years ago, which is the fact that you could be a country that, even if you have a flexible exchange rate, you still have to be worried about these kinds of flows coming from the center reserve currency issuer, which is the US. So that's one. And this is again an issue because right now this has gotten even more significance now because it looks like US interest rates are very low. In fact, for most advanced economies, they're very low, and they're going to stay very low for a long period of time. So we have this situation where we're going to have financial investors looking for yield in emerging and developing economies. So they're going to try to push out and seek opportunities outside. And you worry about a buildup of especially on the debt side, about portfolio debt in these economies. So the fact that, again, they're receiving a lot of capital flows coming from advanced economies because of the fact that interest rates are incredibly low. The returns are very low in those markets. And on the right-hand graph is also pointing to the fact that in episodes of this kind, when you have very low interest rates, you have leverage building up, which is the fact that people are borrowing very heavily in the form of debt to finance their asset purchases. So the leverage ratio has been increasing for banks, for insurance companies, for investment banks. Not, I guess, for investment banks, it jumps around a bit. So this is the capital flow channel. The second piece is about the strength of the US dollar in global trade. So this is a very simple graph over here where the purple line is the world trade volume, and the red line is the dollar effective exchange rate. And you can see it very clearly in some episodes and not clearly so well as in others. But if you look at this and you do this more systematically, you do see that a stronger dollar seems to have a negative effect on global trade. Right? And the question is, why is this the case? And some of it comes from if you have this following phenomenon where all countries in the world are buying goods from each other, and they all are dollar-priced goods, and those dollar prices are fairly sticky, then when their currency depreciates or the currency weakens relative to the dollar, it makes everything that they're buying from the rest of the world more expensive in their own currency terms, and that leads them to cut back on purchases from pretty much every country in the world. So not just the US, but from every country in the world. So you do see a negative impact of a stronger dollar on world trade, and especially trade that excludes the US. So that's another feature of being in an international monetary system with dollar dominance. And of course, more recently, given the heavy reliance on the dollar and given that a lot of the payment systems are US institutions, as we've seen geopolitical risk build up and as the US has imposed sanctions on countries in the world, there is this issue that comes up about other countries being indirectly impacted by it, because if they have to transact with the country, even if they haven't put a sanction on that country directly, if they have to transact with them, they typically have to go through a US banking entity, and that prevents them from engaging in transactions with the other country. So this has also raised questions about the US dollar's dominance and its role in international markets. Okay, so this is where we are. So now I'm going to, so these are the concerns. And the question, of course, is that why don't we end up in a world with multiple currencies? Like, why is there so much of concentration, in the sense that why do we end up with the dollar being used overwhelmingly in international trade, being used overwhelmingly in international financial transactions and in central bank reserves, right? Why don't we share it more? Now, firstly, just from a historical perspective, this is typically how it's been. So before the First World War, it was the British pound. The British pound was the dominant currency, and it was exactly the same way. It was dominant in all these different spaces. Then there were the interbank years, interwar years, when you had some sharing between the British pound and the US dollar, and then there was a period when the dollar again fell off and then came back up in the 1950s, and after that, it's just been the dollar. So you've had, historically, it's always been one currency or the other that's dominated, right? So the question is, why is that? So obviously, there's a reason why that can happen. But that also kind of begs the question of, then how do other countries break in and make this? So, so this is a quote from Barry Eichengreen, who's a historian, who said that experience suggests that the logical sequencing of steps in internationalizing a currency is first encouraging its use in invoicing and settling trade, second, encouraging its use in private financial transactions, and then encouraging its use by central banks and governments. So basically what it says is that it always starts on the international trade space. After that, it moves into private financial transactions, and like the store of value, basically. So you start out with it being a unit of account, payment role. Once you become somewhat dominant there, it spills over into the store of value role, which is in terms of your assets and your liabilities. And then afterwards, it goes into becoming the dominant in the central bank reserves. Okay, so I'm going to give you a little bit of a sense of how this works. I have a full-length paper on this, and I probably can't give you all the details of it, but here's a simple idea. The simple idea works along the following line, which is that suppose, for instance, you're an emerging market, and you, as a household or your firm, you're buying a lot of goods whose price is denominated in dollars, okay? And you live in a country whose exchange rate fluctuates with the dollar. So you have to make a decision about which currency you want to, if you can actually choose, and there's no regulation that disallows it, but there are countries in the world where you can decide whether you want to save in the form of your own currency deposits or save in the form of dollar deposits, right? Of course, there's a whole bunch of stuff that you buy at home in your own currency, so that would give you a reason why you would want to save in your own currency terms. But you also have this other phenomenon, which is because you have these very predictable expenditures that are coming through in terms of foreign currency, and happens to be the dollar, you have an incentive to save in from the dollar terms, because you know that you have these expenditures that are coming through in the future that require dollar payment, and that gives rise to a demand for dollar-safe assets. So if we live in this environment where there's this very large demand for dollar-safe assets, then the question is, who's supplying these dollar-safe assets? Of course, there's the US Treasury, and there's US corporate bonds with AAA rating. But if there's sufficient demand for dollar-safe assets, it's going to attract emerging market banks to become suppliers of these dollar-safe assets, which is to basically issue these dollar-safe bonds, which is what you see in this world. And given that they're not very efficient producers of these dollar-safe assets because they have a currency mismatch problem, the only reason they'll do that is if they have to pay very low interest rates on these dollar-safe assets. So that's what you see in the world too, that the dollar-safe bonds pay incredibly low interest rates. And so with these low interest, because of these low interest rates, that's going to then attract exporting firms who want to borrow to finance a project, because this is cheap borrowing now in dollar terms. Just from the cost of borrowing perspective, they would like to borrow in dollar terms. But of course, there's risk associated with it. They can hedge that risk by invoicing what they're going to sell in international markets in dollar terms as opposed to in euro terms or any other currency terms. Okay? So then that feeds back into this loop. So basically what it's saying is that the dollar's dominance has created this huge demand for dollar-safe assets, which is then feeding back into further invoicing in international trade, which is again feeding into this demand for safe assets, dollar-safe assets. And of course, as a central bank, if you're worried about your banking system and your banking system is heavily dollarized, then if you're going to hold reserves in a foreign currency, the currency you're going to pick is going to be in dollar terms. Of course, all of this requires that for a currency to become a dominant currency, you have to have strong and credible institutions. So long story short, what this is basically saying is there are very strong network effects that generate dominant currencies. They're all in all different pieces of it, the trade side, the finance side, are all intricately tied up. And it makes it hard for a currency to break in. Okay, so let me just skip this, keep up with time. So let's see here. So let me give you a simple example here. So this is, I'm looking at invoicing of emerging market imports and emerging market exports. So just focus on the emerging market imports. What it basically says from the purple bar is that about 50% of emerging market imports are invoiced in dollars, right? So they have very predictable dollar expenditures that's coming through. The yellow portion is the portion that's in euros, so that's about 20%. And by the way, that 50% that's invoiced in dollars, only about 10% of that originates from the US. So basically, there's a whole bunch of other countries selling in dollar terms. And then there's the others, which is the green. And if you look on the right, and if you look at central bank, these emerging market reserve holdings, it's about the same ballpark, which is about 60% of their central bank reserves are in dollar terms, and about 20% is in euro terms. Okay. So here's the question: is what about competitors? For instance, the euro. And what we see here is the left-hand chart is an index, a measure of the international role of the euro. And what you see is there was this, right after the euro was introduced in 1999, you had this increase. That this is an index, so you don't want to take the numbers to mean something specific, but the direction tells you something, which is that you had this increase in the international role of the euro, and then that just came down. And especially during the global financial crisis, the euro lost a fair bit of what it had gained during this first few years after the introduction of the euro. Okay? Question is, why is this? Why has this happened? Let's just look at some other figures over here. So if you look also at the currency composition of international bonds and notes in different parts of the world, there's one place where you see a little more yellow. And as you can see, those are parts that are either a part of the European Union, very closely tied to us. So there's Denmark, Sweden, United Kingdom, or any kind of an EU country that is very closely, geographically close to the euro area. Those are the ones that use it, and everybody else just relies heavily on the dollar. So as of now, as a snapshot, it doesn't look like there is, you see right now, the most recent year, you see this little uptick over there, which got a lot of attention. That this is finally the euro coming back in there. But just as a big picture, there's nothing here that points to a big shift in the dollar's dominance. So the question then comes up: could you do some more? What would the ECB or the euro area, institutions, what could they do if they decided that they wanted to make the euro a more prominent currency? I think one important route to go is to become an important part of global value chains, and especially global value chains outside the euro area. Because when you become an important part of global value chains outside the area, then that's when you end up with importers and exporters adopting your currency in their international trade, and then you can spark this virtuous cycle. As you see there, if you compare the black, the red, and the green line, they're actually all about the same. So if you compare the U.S.'s role in global value chains, if you look at China's role in global value chains, and the euro areas, excluding within the euro area trade, they're about the same. And given that the U.S. has, of course, this very strong first mover advantage, and there's tremendous hysteresis in this game, it's very hard to break it when all that you are is you're in line with where the U.S. is at this point. A second interesting difference is about, if you look at the issuance of euro safe assets, right? So one point that's always made is that the reason the euro doesn't have such a big international prominence is because, unlike the U.S., which issues, more than $25 trillion of U.S. safe assets, there is no such thing as a euro safe asset, right? There is the German bonds, which are safe assets, but there isn't any kind of euro-wide safe asset. And so there's one possibility is issuing those will somehow end up, will help increase the internationalization of the euro. And I have mixed feelings about that particular channel. I just want to flag one thing, which is if you look at the right-hand side, and if you look at, for instance, corporate bond issuance by countries in the world, the U.S. is really the exception in the sense that the U.S. is the only country where corporate bond is issued in dollar terms internationally, and people are willing to hold it. From pretty much every other country in the world, you have to issue the bond in the investor's currency. So whoever you want to buy the bond that bond, it should be in their currency as opposed to in your own home currency, right? And again, the U.S. is an outlier over here because they're able to issue it in their own currency. Okay, so if I would say, but in my opinion, if you were to ask what is the one big thing that the euro would need to do to improve its role on the global stage, it would be about strengthening the credibility of the euro, right? So here is a survey that gets run. So this is a measure of the probability of a euro breaking up. And as you can see, during the peak of the financial crisis, the probability was rather high, and it's come down to now a pretty low level. But I think it's fair to say that if you want to be a dominant currency, there shouldn't even be a survey of this kind, right? It shouldn't be that there is a concern that there is a possibility of the euro actually not being around. And so the question is, how do we ensure that? And that would, of course, require reforms to complete the euro area architecture. And these would include a bunch of things, union-wide, banking unions, capital markets unions, central fiscal capacity. Basically, all the reforms that would be done to make the euro area as a whole more resilient to shocks would be exactly what would help with the euro having a bigger role on the global stage. Okay, now very quickly, the reserve potential of the renminbi, the bottom line is that there has been some increase in the renminbi's use in international trade and in international finance, but we're talking about very, very small impacts, right? We have oil futures. This is the Shanghai Oil Futures Index, and you have that's being issued in renminbi terms too. But the bottom line is that we are still talking about very, very, very small magnitudes. And again, this comes back to, again, what would it take for the renminbi to have a bigger role on the global stage? Of course, in the case of the renminbi, it has to be stronger monetary policy credibility, capital account convertibility, very strong financial institutions. So this would require very strong institutional developments for this to come about, and that could take a long time. Okay, so what about private stable coins? That's another one. So I think this got a lot of attention with Facebook's Libra. Because why? Because in some sense it had all the features of of a genesis of what can become a dominant currency, right? Which is that it was going to first play in the transaction space, in the payment space. And that's where the pound started, that's where the dollar started, right? So this is unlike Bitcoin, where Bitcoin was more about in the, as a store of value in terms of speculation. It was about a speculative investment, right? So that has very little uptake, and there's a bit of a niche audience for it. But when you start entering the payment system, that's when there is this possibility that maybe that the currency could actually be adopted much more broadly. And of course, in the case of Facebook, they have about 2.5 billion users in the world, and so very strong network effects could kick in very quickly. So I think that was what triggered a lot of interest by authorities around the world about what this was going to do. Now again, there are of course gains to it from having these kinds of stable coins, which is the low cost, greater inclusion, financial inclusion, but of course there's a standard set of risks associated with it, with any kind of money being issued. There's also the big concern that it would lead to, countries that have weak currencies. There might be a very quick adoption of a private digital currency of this kind, because that would have much more stronger value and maybe a better store of value than their own local currencies would be. So these are some of the concerns that have come about. So again, the disruption, it kind of plays on the trade side. You have strong network effects. I put up a number over there. So the Facebook has a potential user base of 2.4 billion. I put that compared to the US dollar user base of 4.7 billion. So how did I come up with that number? That's basically looking at the population of the world that lives in countries that are anchored to the US dollar, right? So in most of those countries, if you give people the option of holding dollar deposits, there's a very good chance that they will actually do that. So these are very large size. And of course, then the question is whether that would then translate into, it would start, one of these things could start just as a payment mechanism, but then later on go on to being one of a store of value, and then possibly to other aspects of it. Just one last bit on the role for central banks. So one of the pluses that has come from all of these, private money possibilities, private stable coins, is that I think there's actually been a lot of attention being paid now to the failures or the problems, or the shortfalls of the payment system in the world. For most of us who were taught our macroeconomics over the last 20 years, the last thing we spent time thinking about was payment systems. We talked about, all that we said was if the central bank can control interest rates, your currency is a unit of account in the world, in your country, then that's it. There was no big discussion about money and payment systems, right? Now, of course, this is where the focus is about the payment aspects of it. And the questions are, why do we even need, what exactly is the problem that has to be replaced with a central bank digital currency, right? So right now, if you look at what is central bank money for you and me is basically cash. Cash in circulation, that's central bank money, right? For the banks, they also have bank reserves, but that's separate. But for us, it's basically cash in circulation. And the question is, why do we need to have a central bank digital currency in this world? So there are several explanations, one of which is a real issue, is countries like Sweden, where it appears that cash is completely being phased out. People are not using cash for transaction purposes, right? And then there is a good argument to be made, which is that what happens in that event if, for instance, there is a run on banks or there's a bank failure, and people decide that they want to go out. There's loss of faith in these banking system. They want to convert the bank money into central bank money. Now, if you can go in there, and if you get money in the form of cash, it's kind of a poor substitute, because now nobody uses it for payment purposes, right? So it's heavily discounted. And so from Sweden Central Bank's perspective, they want to avoid that kind of a scenario where people end up with a payment, a currency that doesn't seem to provide the exact kind of payment transactions that they want. And so for Sweden's perspective, it is about basically saying, in an event of that kind, people should be able to get get a central bank money, which is not in the form of cash, but in the form of this kind of digital payment, digital currency, which then can fit in very well with the existing payment system over there. Okay, so there's just that piece to it. But then, of course, there's other parts to it, which is about reducing the cost of holding cash, because it's costly to handle cash. And then there are also aspects about promoting financial inclusion. There are lots of inefficiencies with cross-border payments, and the assumption is that technology of this kind can also help with cross-border payments. So this, I think, is all in the works. It's all, China is very close to issuing a central bank digital currency. Some other countries are thinking very deeply about it, some are not. But we're certainly moving to an international monetary system where it's not just about the dollars and the euro, but also this, is it going to take the form of cash or notes? Is it going to take the form of digital currencies? Okay, so I'm just going to end here because I'm out of time, which is that we're not there yet. We don't have any substitute for the dollar at this point. And again, as history has suggested, there tends to be a dominant currency in the international monetary system. But what this means is that emerging markets have to deal with functioning in this kind of environment where they're hit by these capital flows, where they have to make a lot of payments in dollar terms, have to worry about currency mismatch, which is that they earn in local currency, but they have to make payments in dollar terms, and so those kinds of issues come up. So without going into any details over here, I just want to flag that we're doing a lot of work on an integrated policy framework at the International Monetary Fund, which is exactly to, I'm going to skip all of this, to basically come up with a framework to help countries deal with volatile capital flows, when they can use a bunch of instruments like monetary policy, foreign exchange intervention, macroprudential policy, and capital flow measures, given country-specific characteristics and going into the weeds and looking at what is the shock that's affecting these economies. But basically, the point is this is the international monetary system as is. There is a lot of, it's been a while that people have been talking about whether this might move, and with the euro being introduced, would that change dramatically? Would the renminbi have a bigger role to play? I think the bottom line is that this system will probably stay the way it is for a long time, and it's important for emerging and developing economies to adapt to it. Okay, thank you.
So thanks very much for that great talk. So I wanted to follow up first with a couple questions and then open it up. So you mentioned that the historical pattern and that the UK pound was dominant, the British pound was dominant, and the US economy was larger and was responsible for more trade and was still not the dominant currency, but eventually overtook. So China is more important for trade than the US now. So would you say it's inevitable? It's just a matter of time, but it could take a while, but it's inevitable if they continue to be more and more important for trade that they'll be the dominant, that the renminbi.
I mean, it certainly is a necessary condition, which is that you become a very big player in international trade. That's what it was. It was the UK was the big player in international trade, then it was the US, and of course China now has a big share. But it's far from sufficient, which is that you require very strong institutions, monetary institutions, financial institutions. You're going to have to allow for full convertibility in terms of capital flows of your currency on international markets, full mobility of capital. And so it's not clear that will happen necessarily. And it's not a very clean path towards it. In the past, when there has been the move away from the pound to the dollar, of course, there were the world wars. Something really dramatic happens. The question is whether, I don't know what that event would be.
Okay. Let me follow up. I'm sure there's going to be a lot more questions more directly about the international financial system, but I couldn't help but want to follow up on the digital currency and the private digital currency. So you mentioned, understandably, coming from the IMF, how the challenges that could create for lenders of last resort, or the central bank's role. But how about price stability? How about if there's a private digital currency that becomes heavily used, won't central banks have to be actively involved to maintain price stability?
Right, so the question is, it depends on the details of this. So what exactly does it mean when this currency is being used, right? So the question is, if it's entirely being used as a payment system, which is therefore a settlement currency, then it doesn't have such big implications. But if it turns out to be a currency where people start quoting prices in, so prices are actually posted in the private currency, then that becomes problematic. Now, if it's a stable coin that's entirely dollar-based, then it's not an issue because it's a one-to-one mapping. But if it's a stable coin that has a basket of currencies in there, then of course the impact of your own monetary policy on all of the these prices is going to be much weaker. Okay. So I think that's exactly the kind of things that countries are also concerned about.
Okay. Let me step back and broaden it. IMF outlook gets a lot of attention, deservedly so. So the latest outlook for global growth is 3%. It's the lowest since the global financial crisis. What are the key reasons behind that, and what are some bright spots to cheer things up?
Yeah, so we put out our numbers in October, and we flagged the global growth, like you said, is the lowest since the global financial crisis. It's at 3%. And also importantly, that it's a very synchronized slowdown, which is that about 90% of the global economy is growing at a slower rate in 2019 relative to 2018. Right? So it's a fairly broad-based slowdown. Now, that doesn't mean it's bad every way. The US is slowing too, but from a pretty high level, so the US economy is still in pretty good shape. In terms of what's behind it, I would say three factors. One is the US-China trade tensions have had an impact across the globe on investment. The uncertainty associated with it has led to sharp declines in investment pretty much across the board in all countries. And that translates into demand for capital goods, which then translates into weakness in manufacturing, which then translates into weakness in international trade, because most international trade is in manufactured goods and in capital goods. Second reason is that we have most advanced economies that are basically heading towards pretty tepid growth for two reasons: aging demographics and low productivity growth. So we have this phenomenon of weak productivity growth that is not reversing, and aging demographics. So even if nothing was going on in a cyclical way, we certainly have emerging advanced economies tending towards a low growth potential. And then the third factor are emerging markets. We had a bunch of emerging markets for whom 2019 has been really bad. This includes like Mexico and Brazil, but also includes Iran and Venezuela and Argentina and Turkey and in India, where growth has been particularly weak. And that has nothing to do with the trade tensions necessarily, but their own country-specific factors. So these are, I would say, three sets of factors behind it.
Okay. Last question before I open it up. So, especially coming from the King Center, interested in helping address global poverty and development. So IMF, safe to say, is somewhat controversially has conditionality associated with its lending, these structural forms. Any evolution in the IMF's view or your view about what reforms are most beneficial for growth and development?
No, there's absolutely been evolution, even in terms of IMF practices. So one of the things that everybody pays attention to about what the IMF does is that when you have a country that is in a crisis, is not able to roll over their debts and not able to pay for it, that's when the IMF goes in and provides funding. And of course, the issue is about it doesn't just go in with the money, but it also goes in with there's usually a program that's associated with it, which the country authorities also come up with, and the IMF supports. That involves cutting down on spending, especially on the fiscal side. And so that has always been a concern because people have said, well, this ends up with being a real hardship on the people. And of course, nobody sees the counterfactual, which is the fact that you're going in at a time when, if you hadn't gone in, they would have had to cut spending even more because those funds would not have been available. But I think what the fund has certainly evolved and is doing better now is in looking at the details of where you cut spending, which is to ensure that the most vulnerable parts of society continue to receive welfare, so that because it would be really tragic if they didn't. And then you look at other places where one can, become more efficient on your spending. So to take into account the distributive effects of these cutbacks, as opposed to just saying a blanket, just cut it down, the details about it and how it's going to affect poverty, how it's going to affect inequality. So there's more attention being paid to it. Secondly, there's a lot of work being done now at the fund on these particular issues of inequality, on issues on poverty. So it's become a bigger part of the mandate of the IMF at this point.
Okay, thanks. So I'm gonna open it up.
Thanks for your talk. It was really interesting. My question was about so before the Eurozone crisis, there was kind of a lot of breathless writing about the rise of the euro as a potential competitor to the dollar. And I think implicit in a lot of that discussion, at least in the lay press, was the idea that we should prefer a bipolar or like multipolar system. And my question is should we actually prefer that? And historically, are there cases where that has actually happened? And what can we learn? So when we think about what currencies might rise in the future, should we actually want that to happen? And who would benefit most from that kind of occurrence?
There's some debate on whether we've had episodes of truly multipolarity, which is there have been more than one currency that's shared the world stage. So Barry Eichengreen has the view that there is such evidence of that. But overwhelmingly, it tends to be the case where there's one currency that dominates the outlook. So the question is, what do you think? So even if one doesn't move to a scenario where it's literally shared a third, but there is still some more balance in the system. So there are a few things that countries feel like they might benefit from. One is because a lot of emerging markets, for instance, buy everything that's in dollar terms, their currency movement relative to the dollar matters a hell of a lot, right? And so if, on the other hand, you were buying a bunch of goods that were part dollar, part euro, maybe some renminbi, then the impacts on your inflation can be more muted as long as these things are not moving exactly in the same direction. And so they have to worry less about the inflationary effects of that's one. Second is this phenomenon of this huge demand for safe assets. Is there is a tilt towards not just being any foreign currency safe asset, but it being a dollar safe asset. And then there is this sense in which, because of that, incredible pressure, we're in this very low interest rate environment, and maybe there were more safe assets, and people would think of them as safe because they're actually issued in a currency that they use for consumption or for inputs. Then that might also solve some of that problem. So I think that's the sense in which, but I think one thing we did learn a bit from history is that the transitions can be tricky. Because in the following sense, which is, if there is one clear dominant currency and there's a crisis, then everybody rushes to that. If there are two dominant currencies that seem equally safe in some sense, then anytime there's some issue with one, some sense that one currency may maybe not be as good as you think it is, there's going to be a lot of movement across currencies, which then of course doesn't make them very safe then at the end of the day. So there can be this period where you can have volatility associated in the transition. So these are some of the issues that one has to deal with.
When I think about the transition from the pound to the dollar and the concomitant change in political leadership from the British Empire to the United States post-World War II, I can't help but think that the political factors, as well as the purely monetary factors and the trade factors, played a significant role, particularly with the U.S.'s approach to being essentially a world leader, a global leader. What effect do you think the recent shift in U.S. foreign policy from being a global leader to the call to mercantilism, which our current president has voiced, what effect might that have on the type of dominance that we've seen for the U.S. dollar? Does that open an opportunity for other currencies thus to step forward and fulfill a role that the U.S. is apparently, at least in the short term, stepping back from?
I mean, recently we've certainly heard a lot more talk from other currencies, our currency issuers, about making their currency a bigger player on the world stage. So, there's certainly more talk about that, and some of this is related to the current environment in terms of, trade policies. do I see any imminent change to the system? I don't think so, because of the reasons that I mentioned. There's, if you look at the natural contenders, you think of the euro, there is still that every few months there's always this talk about maybe one country wants to exit the euro area. That makes it, makes it difficult. And then there's China, which has a lot of institution building that's still left to do. So there isn't a natural, currency to come in at this point. So I don't really see a big change at this point.
Hi, my question goes back to the slowing global growth. You mentioned that India is slowing for some internal factors. Would you comment a little bit more about that?
Yeah, sure. So in the case of India, there have been a bunch of things, which is one is income growth in the rural areas has been weak, and that's as they've had this, I guess I would say terms of trade, which is basically the prices of crops have gone down relative to what they consume. The second important factor is the banking sector, the credit creation in India. There are, the non-bank financial institutions. They came under stress in 2018, and they still haven't fully recovered. And then you have a lot of the regular banks that have to deal with non-performing loans, and you have corporations with balance sheet problems, and that has dragged on for a long time. And you've seen this negative impact of this both on consumption and investment in India. So these are some of the factors that have affected. Now they've done some policies that can help, which is the monetary policy rate cuts, the corporate tax cuts. These policies could help with fixing some of these problems.
Thank you for your talk. I saw that the new managing director of the IMF said that climate change is going to be a big thing on the agenda for the IMF this year and in coming years. And I'm just wondering if you could speak a little bit about the details of some of the issues that the fund is thinking through and how to address them.
Yes, no, this is indeed the case. I think the climate is going to be a big topic of work at the fund and in all aspects of it. So when we work with countries, we have to talk about issues of that how climate-related risks, what kind of climate-related risks do they face? How should they adapt to it, and how should they mitigate it? Now, when we do that, of course, we have to think about what kinds of policies would need to be used. So does it take the form of carbon tax? Or are you going to subsidize the investment in climate-safe energy? And then, of course, there's also the question of where is the funding going to come from, right? Because there are many countries in the world that are small and have faced immense amount of climate-related risks, and they would have to do huge amounts of investment, but that just could not be fiscally possible. Right? And so the question is, how would that come about? How would they actually get the funding to make these kinds of investments? So there's the whole fiscal side to it that the fund is going to pay a lot of attention to. We're also going to give countries a lot more information about what we think are the risks to them. Then we're also paying attention to financial risks associated with climate. There are a lot of financial institutions that have made lending, but would not necessarily taking into account climate risks in those assessments. But now those matter a lot. So there's a financial aspect to it too. So there are many areas in which the fund is paying very close attention. I mean, if you look at our, when we look at forecasts for countries' growth and even our measures of where countries have grown, very often there are these natural disasters that seem to be a big part of why we make corrections to the growth for countries. So these are very near and present for us.
In your description of why growth may have slowed down, you mentioned productivity and as the second one. I think that's true.
Yep.
Are there things that you would propose from a policy perspective to address that? I mean, what's the key? Because we would all like faster growth. It's too low. Productivity may be a big part of that. So what would be the things that, on the policy side, that you would recommend for that?
I mean, the bottom line is that is actually a pretty hard question to give a simple answer to. I think there are many people trying to understand the source of this weakness in productivity. So it varies across countries. For some countries, the problem is that if you look at the very top 1% firms, there's no problem with productivity growth. You see that doing quite well. But it's the remaining 99% where you don't see much transmission. You see, and then there's also this phenomenon of you're seeing a weakness in R&D investment. You don't really see that much going on. And so then this is then tied to questions of, is this about lack of competition, not enough free entry into markets? And so this is, we are basically not allowing for sufficient creative destruction as was done in the past. So there's that aspect to it. And then, of course, there is this general feature of when you have aging demographics and, is low population growth, is that also feeding into weak productivity? Now, one policy variable that's being looked at is whether we can use climate investment as being the trigger that generates the next round of productivity improvements. So maybe, public/private, if this is all, if that was encouraged and you had investment in R&D to improve resilience to climate change and to mitigate climate change, then that can be another way of raising productivity growth. So I don't think to some extent, people are still grappling with what exactly is it that's keeping productivity so low, growth so low.
Okay, I think we're out of time, but thank you very much for a wonderful talk, and thanks for your questions.
Thank you.